Welcome to the fundamental guide on building wealth through investing. Investing is not a secret club reserved for the wealthy or the elite. It is a powerful tool that allows every individual to participate in the growth of the global economy. The primary reason you should care about investing is inflation. Over time, the purchasing power of your cash decreases as the prices of goods and services rise. If you leave your money under a mattress, it effectively loses value every single year. For example, what you could buy with $100 20 years ago would likely cost you nearly double that amount today. By investing, you are putting your money to work so that it grows faster than the rate of inflation. The main point is that investing is the most reliable way to ensure your financial security for the future. The most incredible concept in the financial world is compound interest. Compound interest is essentially interest on interest. It is what happens when the earnings on your investments begin to generate their own earnings. This creates a snowball effect that grows exponentially over long periods. Think of it like a small snowball rolling down a hill. At first, it stays small, but as it rolls, it picks up more snow and gains momentum until it becomes a massive force. Consider two people, where one starts investing at age 20 and the other starts at age 30. Even if they invest the same total amount, the person who started earlier will likely have significantly more wealth because their money had more time to compound. Time is your greatest ally in the market, so the best day to start was yesterday, and the second best day is today. Before you buy anything, you must understand the relationship between risk and reward. In the world of investing, there is no such thing as a guaranteed high return with zero risk. Generally, if you want the potential for higher gains, you must be willing to accept higher levels of volatility and potential loss. This is why savings accounts feel safe but offer very low interest rates, while stocks offer higher returns but can drop in value overnight. For example, keeping your money in a bank account might earn you 1%, which will not even keep up with inflation. On the other hand, the stock market has historically returned around 10% per year, though it fluctuates wildly along the way. Finding the right balance depends on your goals and when you will need to spend the money. Let us talk about the most popular way to invest, which is through stocks. When you buy a stock, you are buying a tiny piece of ownership in a real company. You become a shareholder, which means you participate in the success or failure of that business. The reason stocks are so attractive is because they allow you to profit from the innovation and hard work of thousands of employees. If you own shares in a major tech company or a coffee chain, you profit every time they sell a new device or a cup of coffee. However, individual stocks are risky because any single company can go through difficult times or even go out of business entirely. This is why many beginners choose to own many stocks at once rather than just one. On the other side of the investment world, we have bonds. Unlike stocks where you own a piece of a company, a bond is a loan that you provide to a government or a corporation. In exchange for your loan, the borrower promises to pay you back the full amount plus a fixed rate of interest over a set period. Bonds are generally considered safer than stocks because they provide a predictable stream of income. For instance, if you buy a 10-year government bond, you know exactly how much interest you will receive every year until your initial investment is returned. While they usually offer lower returns than stocks, they act as a cushion for your portfolio when the stock market is going through a rough patch. Including bonds in your strategy helps to reduce the overall volatility and keep you from panicking during market drops. If picking individual stocks sounds stressful, you will love index funds and exchange-traded funds, or ETFs. These are essentially baskets that hold hundreds or even thousands of different stocks and bonds in a single package. They allow you to diversify your investments instantly without having to do extensive research on every single company. One of the most famous examples is an S&P 500 index fund, which holds shares in the 500 largest companies in the United States. By buying just one share of this fund, you are effectively betting on the entire American economy. This approach is highly recommended for beginners because it keeps costs low and removes the guesswork of trying to pick winners and losers. Most professional investors actually fail to beat the performance of simple index funds over the long run. The golden rule of investing is diversification, which simply means not putting all of your eggs in one basket. Diversification is the only free lunch in the financial world because it reduces your risk without necessarily lowering your expected returns. If you invest all your money in a single company and that company fails, you lose everything. However, if you spread that same money across 100 different companies, one company failing will have a very small impact on your total wealth. Think of it like a sports team where you want a mix of different players with different skills. You want some aggressive stocks for growth, some stable bonds for safety, and perhaps some international investments for global exposure. A well-diversified portfolio is designed to weather any storm the economy might throw your way. To start your journey, you will need to open a brokerage account. A brokerage is the middleman that allows you to buy and sell stocks and funds in the market. There are many modern apps and traditional banks that offer low or even zero commission fees for trading. When choosing a platform, you should look for one that is easy to use, has a good reputation, and offers the types of investments you want. For example, some platforms are better for people who want to set it and forget it, while others are better for those who want to research individual stocks. Once you link your bank account, you can start with a very small amount of money, often as little as $1, using fractional shares. The process is much simpler than it was decades ago, and most people can get started in less than 10 minutes. Perhaps the most difficult part of investing is managing your own emotions. The market goes up and down, and it is very tempting to panic and sell when you see the value of your account dropping. However, successful investing requires a long-term mindset and a lot of patience. The reason most retail investors lose money is because they buy when everyone is excited and sell when everyone is afraid. For example, during a market crash, the best thing you can usually do is absolutely nothing, or even buy more while prices are low. Think of the stock market like a sale at your favorite store. You should want to buy more when things are cheaper, not less. Discipline and consistency are the qualities that turn regular people into millionaires over several decades of steady investing. You now have the basic knowledge needed to begin your journey toward financial freedom. We have covered the importance of starting early, the power of compounding, and the mechanics of stocks and bonds. The most important next step is to take action, even if it is just a small amount to get used to the process. Remember that you are investing for your future self, and every dollar you save and invest today is a gift to your future. Set up an automatic contribution to your account so that you are investing every month without even thinking about it. Thank you for joining us today and taking this step to secure your financial future.